1 US dollar buys around rupees 95 today, that is in August 2026. Does that mean the Indian rupee is weak? Not necessarily. Here is something interesting. RBI's recent assessment suggests the Indian rupee appears to be undervalued. Sounds confusing? How can the rupee look weak yet to be undervalued? Let's understand it in simple words. By the end of this video, you will know what RBI means and why this matters for India's economy. What does undervalued mean? Most people compare the rupee only with the US dollar, but RBI looks at a much bigger picture. It uses a measure called the Real Effective Exchange Rate or REER. Think of REER as a report card. It compares the rupee with currencies of India's major trading partners. It also adjusts for inflation differences. So, it gives a broader view of the rupee's value. According to RBI's recent assessment, the REER suggests the Indian rupee appears to be modestly undervalued. In simple words, the rupee looks slightly weaker than India's overall economic fundamentals suggest. But remember one point, this does not mean there is one fixed or correct exchange rate. Currencies move every day. Why does RBI think this? RBI studies many economic indicators, not just the dollar. India remains one of the world's fastest growing major economies. Domestic consumption remains strong. Manufacturing continues to expand. Digital infrastructure is improving. Foreign investment continues across many sectors. According to the latest RBI data, for the week ended July 24, 2026, India holds foreign exchange reserves of around US $682 billion. These reserves help protect the economy during periods of global market uncertainty. RBI also studies inflation. It looks at productivity. It considers trade competitiveness. Based on all these factors, RBI's assessment suggests the rupee appears weaker than its estimated long-term economic fundamentals. That is why it describes the rupee is appearing to be undervalued. Then, why doesn't the rupee become stronger? Good question. If the rupee is undervalued, why doesn't it rise immediately? Because many factors affect the exchange rate. Global interest rates matter, crude oil prices matter, foreign investment flows matter, imports and exports matter, geopolitical events matter too. India imports a large share of its crude oil. When oil prices rise, India needs more US dollars. That increases the demand for dollars and the rupee can come under pressure. The same happens when foreign investors move money in or out of India. So, the exchange rate depends on both Indian and global factors. Why should you care about this? A relatively weaker rupee has both benefits and challenges. Let's start with the benefits. Indian exports become more competitive. Foreign buyers can buy Indian goods at lower prices. This can support sectors like IT services. Pharmaceutical companies may benefit too. Textiles can become more competitive. Engineering goods may also gain. Now, the challenges. Imports become more expensive. crude oil costs more. Electronics may become costlier. Imported machinery can also cost more. Higher import costs may increase inflation. That is one reason RBI closely watches the exchange rate. Its main goal is to maintain price stability. What should investors understand? Here is the key point. RBI's assessment is not a prediction. It does not mean the rupee will definitely become stronger. It is simply an assessment based on current economic data. Future currency movements depend on many factors: inflation, oil prices, global markets, capital flows, trade, and overall economic conditions. RBI has also made its approach clear. It does not target a fixed exchange rate. Instead, it works to maintain orderly market conditions. The exchange rate is still largely determined by market forces. So, what is the big takeaway? RBI's recent assessment suggests the Indian rupee appears to be undervalued. That does not guarantee the rupee will appreciate. Future currency movements will depend on domestic and global developments. The assessment simply means the rupee appears slightly weaker than its estimated long-term economic fundamentals. This view is based on measures like the real effective exchange rate or REER. Understanding this helps you look beyond the daily dollar rupee headline, and it helps you better understand India's economy. If you find this video useful, subscribe for more simple explanations on the Indian economy, markets, and finance. Thanks for watching the video.
Thanks for watching. Please subscribe for more videos.